All right. Well, it is 9 o'clock. And without further ado, let's jump right in. This is 15 with Fallon. What we do here is we do quick 15-minute training calls for you as real estate agents to stay up with what's happening in the industry, learn some new techniques, new marketing strategies, whatever will help you get to the closing table quickly and as often as possible. So we're going to bring it back to the basics today. We are going to talk about what we are offering our clients, and that is the investment of home ownership. And I say it like that because I think that because we deal with buying houses all day, every day, I think we kind of start to forget what we're actually doing. We have to remember as real estate professionals that we are facilitating these buyers to purchase one of the best investments they are going to make in their lives. A lot of times, this is one of the first big investments that our buyers have made in their lives. And it's very, very important for us to understand that and really help them to understand that as well. So I know that lately you've all been having a lot of objections from buyers. I have too. I hear it all the time. I hear, oh, I'd like to buy a house, but I don't really think right now is a good time. I'm just going to wait for the rates to come down. I'm just going to hold off and rent. So I've been hearing all the same things. And the truth of the matter is that right now does have its benefits of buying, and we're gonna jump into that. We're gonna talk about that. If you watch this channel often enough, you know that I have said it repeatedly that the high interest rates that we have right now are actually helping buyers get a better deal. So just to kind of reiterate on that, right now, there is not a whole lot of competition because there are so many buyers saying, I'm just going to hold off until rates come down. Even though we do not have a crystal ball and we don't know exactly when that's going to happen, we all hope and pray that it will come down eventually and as soon as possible. But until then, we have a very limited inventory. So that means that there's not a whole lot of houses for sale. That means not a whole lot of people are jumping into, buy and sell real estate right now. So if you have someone that is looking to purchase and they are in the market, they are out and about, there is a very good chance that they will be able to negotiate that sales price a lot easier than we were able to do, let's say, a year or so ago. I see contracts come in all the time where the seller is given a new roof, the seller is repairing what the buyer wants them to repair, the seller's dropping the price, tens of thousands of dollars. So right now, the buyer has the advantage to be able to negotiate because there's not a whole lot of them out there. So when these rates fall, guess what's going to happen? It's going to create more competition for buyers. So then we're going to have buyers competing against each other, which will in turn make those property prices go up because you'll have to pay more for the same exact property that you'll pay less for right now. So I know I've said that before. I want to say it again, but I also want to dive a little bit deeper into that in this particular call today. So let's talk about some terms that we use on a daily basis, but maybe our buyers or our clients, they're not as familiar with them. And one of them is appreciation. We understand what home appreciation is, but let's get back to the basics and let's talk about the definition right now. Appreciation is the increase of value of your asset. So if you purchase a house at $200,000 and in a year or two from now, it goes up in value to $220,000, let's say for an example, then your home has appreciated $20,000. So that is what appreciation is, very simply. But let's take a look at what the appreciation looks like based on historical and forecasted numbers. So very quickly, I am going to go ahead and I am going to share my screen here and to put together a little bit of a chart for you guys. I think it's going to help to show you exactly how appreciation works. So right now, as you can see, this is the appreciation of 1 to 9 years. Okay, so if someone buys a house at $250,000, that's what we're starting off here, and they're putting 5% down, and I'm just averaging out some closing costs here to give you an idea. There is what's called the forecasted appreciation rate, as well as the historical appreciation rate. I am using the rates of St. Tammany Parish for this particular example, but I will say that in preparing for this call, I did take a look at some different cities around Louisiana, and the numbers are very, very close. So they're usually a little over 3%, or sometimes a little bit under 3%. But this is a very good example of what you can expect. So basically what this is showing you is over a 9-year period, historically, there's been a 3.59% increase in the appreciation. So you can see that number go up quite a bit. And it is forecasted to go up as well, 3.12%. So again, over time, as you can see here, a $250,000 house in 5 years has already appreciated $50,000. Now, remember, this is an asset that you are living in. This is an asset that, you are going to be paying to live somewhere, more than likely. You're going to either be paying rent or you're going to be paying a mortgage. So by paying this mortgage, you are actually growing your assets. That is what appreciation is. You are growing, and you are gaining the entire time that you're just passively living and paying your monthly note. So I thought it would be a good idea for us to look at that. I mean, look at 9 years. We're also looking at here, we're looking at the $250,000 purchase is now in the 330 range. I mean, that's quite a jump over 9 years of just paying your monthly note and having a place to live. So that was very important for me to show. Now, there's another term that we tend to throw around a lot as professionals, and we just assume that the clients know what this is, but it's equity. How much equity do you have in the house? We're going to grow and build equity. We say these things, but sometimes they may not actually understand what we're talking about. So to put it very simply, we don't have to go to a screen share for this, but equity is the value of the house minus the amount that you owe on it. That equals equity. So again, if you let's say your house is valued at $250,000 and you owe $200,000 on it, then you have $50,000 of equity in that house. Why is that important? Why would I care about that? Because this equity is an asset to you, and it can be pulled out of your house and used in a way that you feel fit. So let's say you have a child that you need some money for them to have a wedding, or maybe they're leaving to go to college, or maybe it's not even that. Maybe it's just an unforeseen bill, maybe a medical bill or something that happens in life where you need access to that cash. Well, in this particular case, because you have grown equity in your investment, you're able to pull from that and pay these bills. You might even want to just go on a fabulous vacation. Well, guess what? You earned it. You've built the equity in your home to do this. And you can do this with a number of different ways. One of them being a home equity line of credit, one of them being a cash out refinance, but there are options for you. So when somebody comes to me and they say, why would I want to pay that note? My rent is lower than that. It's something that you do have to educate them on, and you have to make sure that they understand that when they pay their rent every single month, even if it is a little bit lower than what they would be paying in a mortgage note by purchasing a house, they are taking that and they are basically throwing it away. They're paying someone else's mortgage, someone else's investment, so that someone else can grow their equity and they can increase the appreciation of their asset. So if that person that is renting and has been renting for, let's say, 10 years, and all of a sudden they come to a situation where they do need some money, they do need some cash, whether it's the college situation or a brand new car or maybe some bills that came up. If they go to their landlord and say, hey, look, I've been paying this for a really long period of time. Can you give me some of it back so I can pay these bills? Well, let's just face it, that's not going to go over the way that they anticipate. The landlord's basically going to look at them like they're crazy. That's not how rent works. And that is the key to what we have to make sure we're explaining to these people. It's not always about, this is the monthly note for rent, this is a monthly note for a mortgage, which one's lower. It's not about that. It's foreseeing the future and to see what is going to set you and your family up, your buyers and their families up for success in the future. Remember, purchasing a home or purchasing real estate is an investment. It's not just a purchase that's used and thrown away. Okay, so you get to live in it. You possibly get to rent it out if that's what you choose to do. But while you're doing both of them, as long as you're paying your bill, you're also gaining equity. All right, so costs of waiting. Let's go back and let's talk about that for a little while. The objection of I'm just gonna hold off. I think rates might come down soon. Well, but rates, we all are hoping and praying that rates come down soon enough, but we do not have a crystal ball. We do not know what's going to happen in the future. So we can hope that in 6 months they're going to be a little bit better, or we can hope in a year that they're going to be a little bit better, but we really don't know. So let's take the guesswork out of this and let's look at actual numbers to see if it benefits us to wait and purchase in 6 months if the rates come down then. Okay. So let me go ahead and share my screen again. Okay. So here is a little chart that I had put together. So again, we have the example of a $250,000 house that is purchased today. So let's say today's rate for this particular buyer, and we are estimating with numbers right now, is 7%. And that buyer says, nah, I'm just gonna wait and let's revisit this in maybe 6 months. Okay, so they did not pull the trigger. So in 6 months, let's say that the rates actually dropped. They dropped an entire percent, okay? They went down to 6%. All right, so let's say maybe the buyer says, all right, I'm going to buy now. Or they could say, nah, I want it a little bit lower. Let's wait and see. So what this chart shows is what the waiting period would be. And let's just, I am literally making these numbers up, but let's just say over the course of 3 years, rates drop down to 5%. Okay. So would a 5% rate be a better monthly note for a $250,000 house? Yes, it would. A 5% rate would make a better note than a 7% rate on a $250,000 house. The problem is what we're missing is that 3 years that we waited, that house is appreciated. And now that house is no longer a $250,000 house. It is a $280,000 house. So now that 5% that we're trying to finance it for, it doesn't go as far as savings go. All right. So the person that decided to pull the trigger and buy the house today at 7%, you can see down here, this is actually the numbers that they would be saving. So if you purchased a house after 6 months, you would actually be better off by $3,421 than the person that waited 6 months to get that lower rate. Because remember, while you wait, your asset is increasing in value. And not to mention that when that 6% rate actually kicks in, there's going to be the buyer competition that we just spoke about. And with buyer competition means you may be paying for more. The seller may not be doing the repairs that you want them to do. They may not be covering the closing costs. So these are all things that you have to take into account. So ultimately, by waiting an entire year for, let's say, rates to go down to 5.5%, this person is missing out on $13,556. That is a huge deal. And then at 3 years, you see the increase there. Now, another kicker is the person that did purchase at 7% here. Well, they don't have to keep that 7% for the life of the loan. They could actually refinance at any point here to one of these percentages, basically as many times as they wanted to, and also get more savings. So this particular number would actually be higher if you're comparing someone who pulled the trigger now at a higher percent versus someone who waited. So I hope that makes some sense. I know that this stuff can get a little bit confusing and complex because there are so many moving parts, but I am going to put this slide on the website. The website is 15withfallon.com. That is, spell out the word 15 with Fallon, and Fallon is FALEN.com. I'm going to put it on there so you can really take a look and analyze this. And keep in mind too, I also have the ability to run these numbers for any region, any price point. We can play around with some of the rates and credit scores. We can take a look at a lot of those things, and you can actually use something like this as a tool for maybe one of your buyers that's actually on the fence and they are considering purchasing, but are a little bit shy to do it because they are just worried about the interest rates right now. I think this would be a very, very good tool to go ahead and show them. So we can work that out. Reach out to me if that is something that you're interested in. And so all in all, again, that is to give you a visual. Hopefully it gives you some talking points to speak to your buyers, and a way to convey this to them that, again, we're not just finding a place to live. This is an investment. This is your future. This could turn into this is some people's retirement. So it is a big deal. The longer you wait, the more you miss out. And as real estate professionals, we have to be able to explain this. We have to be able to educate our clients to make the absolute best decision that they can make and be as successful as possible in the future. So that is the call for today. If you have any questions, reach out. It's so good to see you, and I hope you join me again next time on 15 with Fallon. Have a good one. Bye-bye.